Welcome back. This morning, residential construction numbers were released. New privately owned housing units started rose at 12.2%. Building permits declined around 10%. Kind of a mixed number. The white chart on the right-hand side shows us residential construction numbers. This is specifically new home started numbers. So it was up overall. There is certainly a trend to the downside. I would say it's more negative than positive, all in all. Taking a look at the statistics, we see here it's 1575, which is near the lower end of the range. It's not the lowest low we've seen over the past 10 months, but it follows the lowest low, 1404, which was a previous number. So we're certainly in a very steady trend to the downside in terms of the vast majority of the housing numbers. Again, residential construction numbers increased 12.2%. Again, and you can see it's kind of a choppy number. We go from negative to positive. There's no real, definite direction. However, the down moves in this number, the prior number was a decline of almost 11%. 2 months prior to that, we had a 13.5% decline. So there certainly is an overall negative tone to the housing numbers. Taking a look at the blue line, that represents our custom housing index, and what it's made up of is the home price index, existing home sales, sales prices, active listings, construction spending, residential construction, and we very much turned back to the downside in the housing numbers in this blue line. The red line, which is the inflation index, which is a reason why the Federal Reserve is raising interest rates so aggressively, has now begun to wandered lower, but only to a small extent. I would not necessarily classify this as, a big time reversal. The green line also represents a growth index, and that's also coming off of its highs. Now you look back to the 2008-2009 area, the big financial recession was comprised of retreats in all numbers, the growth, inflation, and housing index. But not so much more recently. We go back to 2019, 2020 when we had that downturn. There was inflation and growth moving to the downside. The housing market didn't really participate in that more shorter term pullback in the economy. Point being is that when we have a significant pullback, a recession, a major correction in the economy and within markets, we see housing participate. Housing is a slower moving industry. It doesn't respond as quickly as, let's say retail sales or, the employment situation. So we're going to look to see if the next housing numbers comes out really continues to propel this blue line lower. If it does, then the overall trend I would say is certainly solidified to the downside. Now, of course, tomorrow we have the Federal Reserve is going to announce their next very important interest rate meeting. We're expecting, I believe, 80% chance of a 75 basis point hike, 20% chance of a 100 basis point hike. Either way, we can see the red line on the top right hand side. That represents all bond yields put together, and that is near vertical to the upside. Point being is that bond yields continue to rise over time. Capital is flooding out of the bond market, specifically with the lower maturity bonds, in anticipation of higher higher interest rates. Higher interest rates tend to make a 5% bond look not so valuable when we can maybe get a 5.5 or a 6% bond down the road. The blue line is the S&P 500, and we can see that there's certainly a very definite trend to the downside in both cases. Take a look at the 1-year bond. Now pays a 4.05% yield. Last week when we spoke about this, it was 4%. The 1-year, the 2-year bonds just do not stop going up in terms of their yields, meaning their prices are going down. Traders are selling the short-term bonds. They're buying the 10-year bond. That's the lowest yield we have right here, 349. Certainly shows us quite a dramatic inversion. Now, the 10-year bond is also rising, but not to the same extent. If you take a look at the comparison between the 1 and 10-year bond, we have a negative 0.56 0.56%, 56 basis point inversion, meaning the 1-year bond pays 56 basis points, over half a percentage point more than the 10-year does. And that has accelerated. Last week we were not, I believe it was in the high fours, maybe low fives, but definitely not 0.56 inversion. And the green line over here shows us a net bond spreads. Now this is the combination of the spread between the 10-year and the 5-year, or I'm sorry, the 10-year and the 7-year, the 20 and the 30, etc. So every pair of bonds put together, that shows us the inversion. And that continues to make lower lows over time, meaning that while the yields overall are going up, the compression between very close maturities is going down. And that's not a healthy sign. That's a sign that capital is moving out of the markets, moving into, well, other safe havens of capital. Taking a look at the bond meter now, the yellow area chart is the S&P 500. And then we take a look at the green line. The green line represents the culmination of all the short-term bonds. So we have in the bond spreads, I should say, so the 5 and 3 year, the 3 year and the 2 year on down. The blue line represents the long-term bonds, the culmination of the spreads. So we have the 30-20 spread, the 20-10 spread, and then the red line are the medium term, and all the bonds in between, the 10 to the 7, the 7 to the 5, etc. And what we're seeing, and just like we saw in June, as stock markets went down, capital moves out of those short-term bonds. A short-term bond is a very reactive instrument in terms of the near-term anticipation of economic conditions and the future of Federal Reserve, activity. And we can see in June, the green line skyrocketed to the upside as equity markets went down. We're seeing the same type of pattern. It's not yet a very fast move, I think, because June was more of a surprise. Remember, we had almost, a regular or a standard, I should say, bond curve, an inclining bond curve, where the short-term maturities paid small interest rates, the long-term maturities paid big interest rates. That was in January. Well, between January and June, all of a sudden, the short-term bond yields spiked higher and the long-term bonds moved lower. This pattern is now continuing. Take a look at the direction of the blue and the red lines. They're now trending lower. It looks like they're almost making new lows. And as the green line makes new highs, all this again is telling us, in anticipation of tomorrow's Federal Reserve meeting, the bond market, which is a very good gauge of economic activity, where the stock market is a gauge of the expectation of future earnings, the bond market tells a story about the growth and about the overall condition of the economy. And that's telling us Federal Reserve is very likely to raise interest rates. I don't think they're paying as much attention to the housing numbers, because the housing numbers are not one of the major factors that the Federal Reserve uses to make decisions. They watch inflation, PPI, CPI, PCE, personal consumption expenditure. That's a big one for the Federal Reserve. Housing starts, not so much. Now, of course, if the housing market really takes a dramatic toll to the turn to the downside, that will lead to lower inflation, deflation, and that could put a pause in the Federal Reserve. But we haven't seen that deflation yet. So as long as despite the fact that the housing numbers look a little tepid, it certainly does not indicate that the Federal Reserve is going to step on the brakes anytime soon. They're watching mostly inflation numbers and also, of course, jobs numbers. And it'll be interesting to see the next non-farm payrolls as they're released. But with that said, the story right now, kind of quiet but down market today on the stock market side. But point being is that we're waiting for the Federal Reserve to announce an interest rate decision tomorrow. And if the bond market's any precursor to what may happen, we could see lower equity markets, higher yields, a stronger dollar, basically a continuation of what we've seen in recent past. We hope this has been helpful. We look forward to seeing you back soon.